Hello, it's John Romcke here from Allegiance Coal. I'm the new CEO of the company and just joined recently and even more recently moved to America to be close to our operations. Thanks, Matthew, for organising Crux Investors for this interview.
Pleasure, John. Look, thanks for coming on the show. Appreciate it. You're a new guy on the block, but I've got to talk about Mark Gray, last guy we interviewed. I think the question people want to ask is why would he go and sell a block of 3.8 million shares days before an announcement, which kind of, ruined the share price?
You have to address that to Mark, Matthew. Mark, was in the process of backing out of the business. He'd brought myself on as CEO. He'd brought a very successful American, Paul Vining, on as chairman. And he was looking to his future and realising he needed to diversify. So that's all I can say about that.
Do you think it's appropriate that he's still on the board?
Look, Mark did a great job of putting these assets together in Allegiance Coal, and we've got two operating assets for a junior coal company. That's a very strong position, and we've got two good development assets. So I think it is appropriate that he remains on the board. As you're aware, Paul Vining had to retire from the board, and that left a hole. So Mark stepped back into the chairmanship role. But we'll go through a board refresh process over the next few months and bring some new talent on.
Okay, well, look, I'm not going to take you out. You're the new guy here. You've been brought on board to fix the perceived problems of the company. And I want to know sort of how real some of those issues are, because the press release that came out on the 18th of July, did for the company and did for the share price. And it talked about you being unable to secure medium-term equipment financing. It talks about, lower than expected performance. And a sort of sequence of issues that had not been sort of signaled or guided to the market previously. So what were the problems you've been brought to fix?
Well, I've come from an operating background and spent a long time in Australia and also overseas for a period, and I want to come on board to really address it from an operating point of view. And that's why I moved to America with my wife. We're locating ourselves right next to the coal mine that has the greatest potential, but also particularly some of the problems. I think in the past there was a fair bit of optimism in the company that we could grow this company fast, and that proved to be a lot harder than people believed. And hence, when I was part of drafting that release, I want to put the cards on the table, and that's why we're saying we're no longer giving those robust guidances. And I'm here to fix the problems, and once the problems are fixed and we generate the results, we'll release that to the market.
Okay, well, let's talk about some of the problems, or let's talk about some of the opportunities. First of all, the coal market continues to be stellar. Prices are good. Margins should be good. So let's start with the assets. Have you got the assets that are ever going to be able to, give the company the kind of returns that it previously hoped for?
I think there's different problems at each mine. So let me address the mines individually. The New Elk mine, as I mentioned, has probably got the greatest potential. It's got a wonderful resource base, but it's also a fairly remote mine. And that's been difficult for us to attract the workforce that we need in order to reach the productivity levels that we're expected. So that's one of the key issues to correct. The way we're going to go about that is introducing a 7-day production profile over the next few months, and be able to pick up additional shift workers by being able to attract them using an attractive roster. So I came from Queensland. We operate many mines up there on a 7-day, 7-off basis. And so we're going to structure ourselves so that we head in that direction. We're not there yet. We haven't got enough people to fully man that. But that's the proposition over the next month or two to attract those people.
Okay, so that's one thing. What else we got?
Yep. The other issues are the equipment reliability issues at the mine, particularly the continuous miners. The continuous miners we put back into service when the mine was originally conditioned. It sat out on the surface for 8 or 9 years while the mine was on care and maintenance. And so they're also fairly dated, very old electrics in their system. They're Joy electric systems. So we've started an overhaul program and to put very modern electric systems into those miners. The first miner is due to come back next week, and that's been overhauled by Philips Global, and it'll have a Seminco control system right throughout, and a new triple VF drives in the tramming motors. So
you're getting all technical on us. What
yes,
does that actually mean? What's the benefit of doing that?
But what that'll do, it'll take a reliability that's down around 75% of uptime compared to what it should be is at about 92%. So it's a material increase in reliability.
Gotcha. And then what does that convert to in terms of dollars for you? How does that improve things?
Well, we've spent about $800,000 on this first one. The second one will also be about $800,000. And that's part of the reason that we've gone into this entitlement offer to raise funds at present. So they're probably
when you look at stuff like that, John, you go, right, I'm going to spend 800 grand here, but it's going to give me a 2x, 3x return in terms of productivity, or how do you measure it?
Yeah, well, the productivity will come because of the uptime, the improved uptime. But the two important parts are the equipment itself and then the right people to also maintain the equipment. So they go hand in hand. I do need extra maintenance staff to bring the equipment up to scratch, and to be able to maintain that in a professional-like way.
Right. So we've got staff, we've got equipment. What else do you need to fix?
They're the main two issues at the moment. If I fix those issues over the next 2 or 3 months, I'll be a happy man, and we will generate additional tonnes. We're running, at about an average of 20,000 tonnes a month, and we need to get that up to 30 and 40,000 tonnes a month, and that's where we're heading.
Right. Okay. So new people cost money because there's training involved. That increased wages presumably in this current environment. You're going to perhaps have to do some kind of fly in, fly out type solution.
Potentially, yes,
yeah.
We're talking two different groups at the moment. There's some opportunities. There's a couple of mines that have got issues. One's shutting down completely, so we'll be out trying to recruit experienced people who know what they're doing to participate in our place.
Right, and so where are you at with the money you need to make these two sets of improvements?
Well, we commenced just before we go there. Let me talk about Black Warrior Mine,
sure,
because that's the other operation. It's also in expansion mode at the moment and building up. It hasn't happened as fast as what it was, and that was in relation to the some of the financing issues. But we've now cracked most of that, and we're commissioning a D11 dozer either next week or the week after, which will be the first of two to bring to the mine. We've commissioned one out of 2 new drills that will come to the mine, and that additional capacity will actually reduce our overburden removal capacity using dozer push and bring down the operating costs. So with those 2 steps, it will be completed by December, and that will give us a run rate that will be profitable and reduce our costs. Funding, we've recently kicked off the entitlement offer. We were successful in raising $15 million on the Australian stock market from the institutional component. We've nearly completed the retail component. That finishes on Monday of next week. And then if we don't get to the full entitlement offer, we've got a couple of months of marketing the shortfall. So a combination of that funding and where I think we'll end up with the new Marco sales agreement will give us the run rate that we need and the cash flow that we need to make sure that we can be successful, Matthew.
I mean, obviously, the press release recently about Marco not doing what they said they were going to do, needing a bit more time on their side, won't help with those conversations. It doesn't lend comfort given the backdrop that we're coming from, right? Yeah,
we were pretty disappointed last week when we came to the conclusion that they weren't going to honour the payment structure that they'd signed up for. However, as an interim solution, we've struck a rate this week where they will continue to provide our inventory finance process, so that delivers us cash flow. That's on the basis of a price of $210 a tonne, and they'll provide 85% financing as it's delivered to the stockpile at the port. We're following up and continuing discussions to finalise what the sales contract will look like. and as soon as we do that, we'll release that to the market as well. But at the moment, it's looking pretty. It will be okay. It won't be as good as what we believe we're going to achieve and what we've previously released to the market, but I think we'll end up in a position that is certainly okay in relation to our costs and will give us an adequate margin for the next 12 months.
Okay, but how does one end up in a situation like that? Like there's lots of kind of traders around, and you got presumably in this market a kind of choice of people to work with. Or do you? Because again, the kind of backdrop from which you come, people are going to be slightly risk averse and make their own assessments here. But it seems like Romcke had problems of their own, unrelated to your situation.
I think it's a timing problem for them. I think we struck this agreement nearly a month ago now, as far as putting on the table to the market what we'd agreed. Romcke were unable to fix those sales as quickly as they expected into Europe, and the market moved against them in Europe. And so that meant they were in a position where they were going to be out of pocket if they commenced this business. However, they continue to make some progress overseas now, and I think very soon we'll know what the final outcome is.
Right. Okay.
As far as other opportunities, we because of what happened late last week, we've certainly gone far and wide and looking for other opportunities to sell our coal, and those discussions will continue. At this stage, probably the pricing does not meet the pricing that Marco's put on the table for our inventory financing. So at this stage, we indicating that we will take up that inventory financing arrangements. That doesn't mean we're locked in to sell our coal to Romcke. We're still assessing our options, and that assessment will really be based on a combination of volume and sales price over the next 12 months, because that's what we walked away from.
Yeah, I mean, it's a really interesting one. Okay, these conversations don't match what Romcke want to put on the table. They haven't put anything on the table at the moment because they can't deliver. So, how strong is the market, and what's your expectation of being able to get other deals done or talk to other groups?
Where I actually want to go is twofold. One is, if we complete with Romcke, then that gives us a runway. I think that runway will still be 40,000 tonnes a month, but my goal is to produce more than that as a company, and we'll be pushing up to 60 and 70,000 tonnes a month next year by April. And that excess production, I've got two opportunities. One is to continue to push into the thermal market with other customers so that we diversify and we're not relied on one company. But the other thing is that eventually the thermal coal market will readjust. I don't anticipate we'll be in this situation where you can sell thermal coal for more than coking coal, met coal in the future. So my real goal is to, attract some HVA business again out of Mobile, combination of New Elk and Black Warrior coal as per our original. And so we will pivot back at the right time into the met coal market. And that's where I think Allegiance Coal will focus on for the longer term. And that also matches our new projects, the Short Creek mine in Alabama and also the Telkwa mine in British Columbia. They're both good metallurgical coal projects. So that's the space longer term that I think we should go back to.
Great. Okay, so that's good news. And let's to that end, let's talk about this, because you're 20,000 at the moment, want to move to 30 to 40. You just talked about 60 to 80. That's going to take some planning, and it's going to take some time, and it's more than picking up and fixing the electrical equipment on individual bits of equipment. So you're going to need a big chunk of change for that. So do you need these contracts in place to be able to kind of get whether it be equipment finance or other type of finance in place?
I think what we need, Matthew, is some run rate and see some success in the business first. and that's why some of the expansion projects we're putting on hold until we get this business running. Until we get the business that we've got, we're not going for a big expansion. We're not building the railway to New Elk, those sorts of projects that have been talked about in the past. We've got to make sure that this business is cash positive. It can survive. It doesn't need to keep going back to equity in order to prop ourselves up. And that's where we want to be in the first half of next year.
Right. Okay. And you're all the time doing which is great. So you're minding the dollars, as it were, and the market will do what it does, and maybe we get back to met coal. Brilliant. But you're doing this in an environment with increasing energy costs in the US, like us here in Europe. That's going to affect transportation costs, which is a big part of, certainly when you did the strategic review, there's huge inefficiencies in terms of the transportation component. Is that getting fixed? Are you in control of that, or what are your options?
Yeah, I think we are. We are a bit of a price taker, where the major railway companies are pretty dominant in that pricing mechanism. But we're actually seeing that pricing lift in the US. The diesel prices are starting to come down again, those energy prices, which is different than the European experience, of course. So we see some of our rates and our barge rates out of Black Warrior actually coming back down, which is very positive. We've also created the situation where we've got a bit of competition in the railway market for New Elk, with both Union Pacific and BNSF in effect competing for some of our business. So that helps us keep the railways a little bit pencil sharpened, but it's certainly not cheap, and it'll never really be cheap. But I think using those sorts of methods, the fact that we've commissioned that second train, gives us a little bit of an edge to do that.
Right. Okay. You've given us a clue about some of the things that you've identified which need fixing and so forth. But what do you put all this down to? I mean, I think you've hinted at slight exuberant view of what could be achieved by previous management structure, right? You've given us that clue. But what else is it? Is it a case of, supply chain issues, whether it be at port or with the trains? Do you put it down to, well, we weren't able to recruit the right people in enough of them with the right skill sets? Or was there kind of one big thing, or was it a series of
No, I think it's a series
missed
of things and
opportunities?
a series of challenges. You'll remember earlier in the year we had accommodation issues, and that was a problem recruiting people. That seems to have been addressed in the first half of the year now, and we've now got a number of accommodation units available, ready for new people to arrive. So we've done a fair bit of work in the background to solve those issues one by one, and that's what we'll continue to do, and drive up the production rates. So.
Can you? Okay, sorry, I just remembered something that Mark said to me. The equipment was too small. He was looking for bigger equipment. So is upgrading the electrics and upgrading them, well, and however else you're going to upgrade them, is that going to be enough to do the 40, 60, 80,000 component, or is it just that's a quick fix for now? I mean, how are you viewing that?
Yeah, I think primarily that, combined with the people issues, will solve the biggest part of the productivity equation that we've had at the New Elk mine. At the Black Warrior mine, it's the bigger equipment that you spoke of. The continuous miners and the coal haulage equipment at New Elk, it's matched to the seam height now. So we're in a pretty good space as far as that goes. We've got a fleet of ram cars which were sourced from Komatsu, which is the supplier of those. So that process is finished. That happened in the first half of the year. Now we're addressing the continuous miners. We're also have got in our plans to acquire some more roof bolting machines for New Elk, which is part of the entitlement offer, sourcing those funds. So they're the key production equipment underground. We've got quite reasonable and good quality conveyor belts. Take the coal out. The coal prep plant is working pretty well. I think the pieces are all there. But as I say, we want to complete these continuous mine overhauls, and we've got to bring more people to the mine and roster, staff ourselves up at New Elk. So.
Right. Okay. So you're an operations guy. You come in as a turnaround expert, right? But the share price today is sitting at 7 times lower than it was before that July 18th announcement, right? So it's a heck of a recovery required here. So without referencing the operational components which we've discussed today, what are the targets that you or the board have set yourselves, which will allow you to say, do you know what? I think this is going to work. Because with public companies, the trouble is on behalf of the shareholders, you've got to try and people kind of flog a dead horse sometimes. It's like, but there's got to be a moment you go, do you know what? This ain't going to work. So what are the thresholds you've got to hit?
Yeah, I'm not ready to say it's not going to work, Matthew. I'm here to make it work. I think the thresholds that we're going to go to are achievable. We're going to move into an area that's got a slightly thicker coal seam as we move further to the east in the underground mine workings. That's certainly helped the productivity as well. But, I know I sound like a broken record, but fixing the continuous miners and investing in better equipment and investing in some rosters that will attract people to the mine, they are the two major issues that are going to give us the edge. Now, we haven't solved them yet. I'll be the first one to say, okay, I've asked for this time. Let me come back to you in after the Christmas holidays and tell you where we're at, and then I'll give you an indication whether we're very much on the path to success or whether we're still bashing our head against a brick wall and not being able to get the right team in place. I think the continuous miners, this is a really test for the overhauls once we get this machine into work. And it's not only a test for us, but also for our supplier we're using, Philips Global. And we're really looking forward to them proving to us that they can do the good work and the reliability will be improved. So those are the components that are going to make this place work. I think Black Warrior's on a good path at the moment. It's well organised. It's got a repeatable mine plan, taking strip after strip in the open cut mine. And I'm very confident that place is going to be at where we want it by December.
Okay, so let's say New Year, you're going to be able to come to the market and say that this is working or not.
Yeah,
is that what you're saying?
Look,
okay.
I think numerous investors have talked to me and said, look, there's been a bit of a dearth of communication, and I've apologised to them and said, look, I've been getting my feet under the table, understanding what the business is, understanding what we need to do, and I've been loath to go out there and make promises because that's what we've done in the past. Now that I'm on a path of doing that, I think the investor communication does need to and will improve. So that's my promise to shareholders.
Good stuff. I'll see you next week. No, we should. I want to talk about one thing. Look, like I said, you're here to turn this around. Okay, your feet have been under the desk since August, and you've been assessing it. So I'm not here to dig you out. I just want to know what's going on, and you've been clear about it. So fair enough. There was a little sort of little present there potentially for shareholders. Proposed bonus issue of options. What's that about?
Yeah, that was something that was proposed by our broker as we went into the entitlement offer place. And it really is, as it says, it's a bonus. They're free options. And it was put a marker out there that, we're languishing at 5 cents a share at the moment. That's not where we belong. We want to get back to 40 cents and then 60 cents and 70 cents. But on the way, the existing shareholders that are participating in the entitlement offer, the existing shareholders that have remained loyal and kept their stock rather than selling them, that's who we want to reward with that option. So the options are live for 3 years, and after we get to 15 cents, you're in the money, and it hasn't cost you a thing. So it's another a way of enticing people to stay with us and to give them a reward when we're successful, Matthew. That's what it's about.
Okay, John. Well, I appreciate you coming on coming on and spending the time with us, and promising to see more of us and other people, and update your shareholders as to where they stand with this. I look forward to speaking to you again soon.
All right. Thanks, Matthew.